What's happening with the Japanese yen right now is revealing massive structural issues in the global financial system. And the New York Federal Reserve might have just acknowledged that. On Friday, the Japanese yen strengthened versus the dollar by 1% within minutes. And this move left foreign currency traders rattled, wondering what on earth actually just happened. Currencies aren't supposed to move like that. You have massive amounts of leverage in foreign exchange markets because there's typically lower volatility and very predictable trends. But the situation with the Japanese yen right now is at a tipping point, and what happened on Friday might be revealing that something just broke. So, what exactly is going on here, and what does this mean for you and your money? If you aren't familiar with the situation in Japan and the Japanese yen reverse carry trade, then I highly recommend that you watch my video where I fully break that down, and you can find that in the YouTube cards up here. But to sum it up, Japan maintained a near zero and even negative interest rate policy for over 2 decades to deal with a deflationary spiral. In the late 1980s, Japan experienced one of the largest bubbles in modern history, and then that bubble popped. And so, once that bubble popped, for decades, Japan was dealing with deflation and zero growth. Prices didn't rise, wages didn't rise, people were delaying their spending, and companies hoarded cash. So, in an emergency reaction, Japan made drastic policy moves. They slashed interest rates down to zero and even took them into negative territory. They borrowed money to spend on infrastructure and made massive purchases of Japanese government bonds under a yield curve control program. The goal with the yield curve control program was to stimulate economic growth by pinning short term interest rates at negative 0.1% and 10-year government bonds at around 0% by purchasing bonds. Keep rates low, people can borrow, and then they can go out and spend and invest in the economy, hopefully bringing them out of that deflationary spiral. Now, after 30 years, Japan finally got the thing that it had been looking for, which was sustained inflation with rising wages. So the emergency was over and the Bank of Japan ended its emergency programs. So in March 2024, the Bank of Japan ended its yield curve control and began a hiking cycle where they started to raise interest rates. And when they first did this, markets didn't like this at all, and part of that had to do with the Japanese yen carry trade. When the Bank of Japan kept rates at zero and even negative, a bunch of people went out and borrowed Japanese yen to go out and invest in assets that had higher yields. So you borrow money at low interest rates and invest it at a higher rate and profit on the spread, or what is called the carry. Well, when the rate on the Japanese yen goes up because the Bank of Japan is hiking rates, then the amount that borrowers pay on that borrowed yen goes up, and therefore the spread that they are earning on that trade will shrink. And this forces investors to close out some of their positions, for instance, by selling stocks so that they can pay down the loans. And this is why the Bank of Japan hiking rates can have an impact on all of global markets. The Japanese yen has been borrowed to buy all kinds of risk assets all over the world. But now Japan is on the other side of the deflation problem and is worried about potential runaway inflation. So it would much rather hike its interest rates now and faster so that it can prevent long-term inflation expectations from getting too far out of hand. The yield on the 30-year Japanese bond has been absolutely melting faces, partially on these rising inflation expectations. We saw the yield on the 30-year Japanese bond surge by almost 40 basis points within a week. For reference, that's almost a 15% increase in borrowing costs on long-term debt within a week's time. So the Bank of Japan's need to raise interest rates to keep inflation in check is real. They want to keep investors from selling off these Japanese bonds, which is why these yields are going higher. But it has to consider the potential impacts of the further unwinding of the Japanese yen carry trade, also upcoming elections and overall global uncertainty. On Friday, the Bank of Japan had its policy rate decision, and it decided to keep rates at 0.75% after a 25 basis point hike at the previous meeting. But when they did this, something happened. There was a report that Japanese authorities and potentially also the New York Fed may have worked together to perform a rate check, where they essentially telegraph that they might intervene in Japanese currency markets by calling dealers to get quotes on the currency. And the reason that they might do this would be to prevent the Japanese currency from collapsing from a weakening demand for Japanese bonds. Lower demand for sovereign bonds means a lessening demand for the Japanese currency to buy those bonds. This rate check might have been what sent the Japanese yen 1% higher versus the US dollar within minutes. But why would the US be invested in helping to support the Japanese yen? Japan is actually one of the largest holders of US treasuries, often sitting at over $1 trillion in holdings. And so extreme yen weakness could force Japanese authorities into tough choices. It could defend the yen by intervention by selling US dollars and buying yen, which would involve selling US treasuries to raise those dollars first, or allow their bond market to continue to fall and their currency to collapse with it. If Japan sells off US treasuries, then that could spike short term yields for the US, which would raise US borrowing costs, disrupt overall bond markets, and also complicate the Fed's policies or even the debt refinancing that the US Treasury is trying to accomplish this year. Now, I'm not a financial advisor, and none of this is financial advice. Please do not take financial advice from a random guy on the internet. But if the US does step in to help Japan support its currency, then there could be some sort of a coordinated effort to sell dollars and buy yen. This has happened in the past, in particular in 1985 during the Plaza Accord. This would point to yet another reason for a weaker dollar in 2026, which could be extremely bullish for all risk assets. We're starting to see a reason for currency markets to experience much more volatility this year, so I'm going to be keeping a close eye on them. If the yen continues to gain strength against the dollar, then assets like gold, silver, and Bitcoin will be likely to find further strength. But I don't know, maybe I have completely lost the plot. What did I miss? What did I get wrong? Or how could I be looking at this differently? Let me know in the comments down below. If you want access to deeper insights on what I'm actually doing with this kind of information and to get your questions answered, well, if you like reading, then consider joining my Patreon for my weekly macroeconomic newsletter. Or if you want videos that go more in depth on what we're doing and to properly join the community where we're discussing these things, then I just launched my channel memberships. The macro analyst tier members are getting exclusive videos that go into depth on what I'm seeing and what I may be doing. You can find the links to that in the description of this video down below. And if you haven't already, you gotta subscribe to my live show that I do with Ben Levitt. It's called Memes and Markets. We go live every Tuesday and Thursday at 12 p.m. Eastern, and we discuss topics like this live, so you can join us in the conversation. You can find that at the link in the description down below as well. I'm Keith D. I'm here to talk everything money and markets, and if you enjoyed this or got anything from it at all whatsoever, be sure to hit that like button and subscribe. Until next time, peace.